Today we are going to talk about liquidity, and the million-dollar question is what really drives the price up and down? Is it the fundamentals? Is it the oscillators like RSI or MACD? Is it the so-called support and resistance? Maybe a little bit of everything, but professional traders think differently. Keep in mind that us as retail traders, we are trading with fairly small amounts, maybe hundreds, maybe thousands of dollars, sometimes maybe tens of thousands. But when we are talking about professionals like institutions and banks and hedge funds, they are putting out their positions of tens of millions or hundreds of millions of dollars. For this sort of liquidity, they need to access pockets of liquidity where this money rests. This is the reason why the name of the game is chasing liquidity. There is nothing more important, in my opinion, than liquidity. And if you understand that, you are basically starting to trade like a professional. In today's video, we will talk about liquidity and how you can benefit as a retail trader in playing like a professional. This is the edge that I'm going to give you in this video. I'm the NQ Whisperer. Join me. So today we are going to look at the charts and understand where the liquidity rests and how we can use this idea, this concept. But before that, we need to understand a very important concept. And this is the concept of swing points. As you can see here on the left side, we have this candle here with a lower low, and to the left and to the right of this candle, we have higher lows. This point over here is called a swing low. So a swing low is that point, that candle, which is surrounded to the left and to the right by higher lows. In a similar concept, on the right side here, we see a candle in the middle that has the highest high compared to the candle on the left and on the right. This point over here is called a swing high. It's as simple as that. So in any succession of three candles, if the middle one has the lowest or the highest point of any of the three, that point will be called a swing point, either a swing low or a swing high. Why is this important? Imagine that in this case over here, when the traders have seen that the trend has switched from a downwards trend to an upwards trend, then they want to go long, okay? And they may enter, let's say here, setting their stop loss below this swing point here, and of course targeting higher prices. What will rest below this swing low over here? All their stop losses, which will trigger if the trade is going to go against them. So if the price is going like this and reaches this area over here, this means that their stop losses will trigger and they will have to sell their assets in order to cover their positions. For this reason, this point, this level over here, this swing low over here, is called sell-side liquidity. All right? In the same idea, when a trader sees that from an upwards trend there is a shift in a downwards trend, they will want to go short in this area, let's say, setting their stop losses above this swing high and targeting lower prices. In a similar situation, if the trade is going to reverse and move up again, they will be forced to buy the asset back in order to cover their positions. For this reason, this level over here, this swing high over here, is called a buy-side liquidity area. This is a very simple concept, very easy to understand, but paramount to understanding where the market will go and how the market will react, because these swing points not only have liquidity resting above and below them, but they are very high probability points where the price will react in a way or another. And we will move on to the charts, to the real charts, in trying to understand where these swing points lie and how the price is reacting when reaching them. All right, so this is the chart of Nasdaq, is the daily chart of Nasdaq, but it really doesn't matter. The concepts that I told you about, they apply to all kind of assets and all time frames. This is a fractal that you can identify on every time frame. So bear that in mind because this is very important. And for the beginning, we will try to do a simple exercise just to identify the swing points on this chart. And I would say even we will go a little bit further to see what conclusions can we draw from this simple exercise. And I will start from this point up here, which is obviously a swing high. I remind you that every swing high needs to have to the left and to the right lower highs, and every swing low, as we have here, needs to have to the left and to the right higher lows. So this is a swing high, it follows a swing low, then we go down here to another swing low, and then let's see what we get next. We are on the replay mode, so it's easier to get the price action. If after this green candle we will put a higher low over here, this will transform this point over here in a potential swing low. Let's see. Okay, and we got it. So we have another swing low over here. We're moving forward. We have another swing point over here. Remember, this is just a simple exercise to identify as the chart progresses where the swing points will be formed. Okay, this is another swing low over here. We move forward. We have another swing point over here, swing low. And so on and so on. We have another swing low over here, and we have another swing low over here. And you can continue this exercise on your chart. And I want to point out just a few things. Okay. First of all, it's obvious on this chart that not all swing points are equal. Some are formed during the trend, some are formed at the end of the trends, and that in particular, that makes a huge difference between them. If we take this example over here, I would consider this swing high over here and this swing low over here as being the beginning and the end of a short down leg. So I will wait and be very curious to see how the price will react when it gets to these points, and I would point them out as buy-side liquidity and sell-side liquidity. Okay, let's consider that this is a so-called range. Why are they so important? Because, as I said, the reaction of the price when it gets there, it's going to tell me a lot of things about the future trend and how things will evolve in the next few days and weeks. All right. Second thing, from time to time you will notice that you will get swing points like these two over here, which are very close one to each other. This is one of the most powerful, let's say, pattern on the chart, because as we were saying in the beginning, if these swing points and buy-side liquidity and sell-side liquidity are pools of liquidity, imagine that a combination of two or more swing points in very close proximity, as we see down here, this is double or triple important because we will have so much more liquidity as these points are very close on the chart. All right. So this is another conclusion that we see from this very simple exercise, namely the fact that the buy-side liquidity and the sell-side liquidity are obviously drawn liquidities, magnets for the price. And this is even more clear and even more important when we have equal highs or equal lows, as we have down here, equal lows. I hope this is clear. And let's see what kind of reaction, where, first of all, where the price is going to, and secondly, what kind of reaction we will get once the price is getting either to the buy side or to the sell side of this range. All right, we're still ranging. Okay, and the price is taking the buy side liquidity out, and we get a couple of solid green candles closing well above the buy side liquidity, indicating that the price is willing to move higher. If we have got a reaction whereby the price was taking this liquidity and getting back into the range, that would have increased the probability that the price is not yet willing or ready to go up, but rather to go down to the other side of the range. And let's see how the price is going further. You see we are creating continuously swing points. Okay. And if we are looking, for example, up here where we have created another swing point, first we have rejected from it, but the price didn't get too far below. Okay. And then we moved up above it with strong candles, retested it, and probably continued to the upside. All right. So these are the three lessons that I wanted to show to you. First, how to identify on the chart the swing points how to identify the buy side and the sell side liquidity, how to expect a reaction and watch what the price will, how the price will react to this buy side or sell side liquidity. And based on that reaction, you can position yourself in the market with trades because you have the conviction that when a liquidity pool is reached, that reaction is very telling, is very clarifying about the future trend of the price. All right? Good. Now, I was saying also that not all swing points are made equal. And I would like to go with you through a few types of swing points that I'm using, and maybe you will want to use in your trading strategy and preparation. And for me, here we are on the daily chart, and obviously the previous day high and previous day low are very important swing points. Now, let's put it on the chart, okay? This would be this day's previous day high, and this is the daily low. All right. And now you will say, okay, yeah, but this doesn't look like a swing point. Okay. Correct. But if you go to the pairing time frame, which for one day is the 1 hour time frame, we will see that these 2 points, previous day high and previous day low, are what? Swing high and swing low. All right? Fair enough? In the same way, if we go on the weekly chart, we will want to use the previous weekly low and previous weekly high as points where price will have an important reaction moving forward. Okay, therefore we want to mark it for example, at the beginning of the week. We are, let's say, in a Monday today, and we have the full week, the last week closed already. We mark these 2 points on the chart, and for the coming week and for the coming days, we will watch if the price wants to reach either side of this range, and we will have to follow and to understand what is the reaction of the price to these 2 levels. So previous week high, previous week low, previous day high and previous day low. And also for whoever is transacting Nasdaq, like myself, the session high and low, the sessions high and low are also important levels to be monitored on your chart. What do I mean by sessions highs and lows? Obviously, you understand what I'm talking about. I'm talking about Asia high low, London high low, and obviously AM session high low, and so on and so on. All these levels are important levels, and it's important when you prepare for trading to have these levels on your chart in order to observe the reaction of the price when it goes through them. All right? I hope it's clear for now. This is the liquidity presentation that I wanted to share with you. I hope at the end of it things are more clear. I would like to discuss with you. If you have any questions, please write in the comments and I will come back to you with answers. Thank you very much for watching. Like, subscribe, and share. And I will see you guys in the next one.